So this video I'll be talking about liquidity. It's a really fancy word. And so many people like to use the word even if they don't know what it means or they don't know how to use the idea, like use liquidity to trade. Like they don't know how to trade liquidity. So I'm going to do this. I'm going to explain this way. You see this all the time. If you've traded the market enough times, you see price do this, do this, do this. And this is one of the times where all the things I've been talking about in previous videos. This is one of those times when you be like, this thing does not add up. I mean, you said this before, how come you're saying something else? You just have to pay attention. That was foundational. Alright, so just like pay attention to what I'm about to say. So the market does this and does this, and I said this is what? An uptrend. Okay, but now you take a buy. So the market comes down here, and you're anticipating this. So you take a buy from this point. And like I said, stop loss below the what? Previous low. This is what they want you to do. Okay, so there's a zone up here where they want price to reach. I mean, that's where price is supposed to reach. This zone. So let's say this is a supply zone before price is supposed to fall. Okay, but they won't do that right away. Okay, the market is going to get, your order is actually going to be good. It will go all the way. It might even come close, but then that's as far as it's gonna get. And then they will do this, come down, take you out, you know, before eventually going there. So let's say you knew this was a take profit, and this is one of those times where it will save you to just take your profit at the previous highs. But let's say you know this is a supply zone, so you're targeting the supply zone, and they'll do this. This is going to take you out of the market, and all your buy positions, because these people also want to buy, they want to make money off this upward push. So all your buy positions are automatically going to be sold to them. Like they become sell positions when you hit stop loss. Okay, even when you hit take profit. So it's basically taking you out of the market and taking all that funds from you, you know, to them, you know, sending it to them. So it's easier for them to, like, since they want to buy from someone who is selling. So you're forced to sell because you didn't see what they saw. All right, and that's mostly when things like supply and demand always comes in handy, because imagine there's a supply down here that has not been touched. Price is going to come down, seek that supply, and boom, get enough gas to go up. All right, so this is one. Now there could also be the presence of fair value gaps, which is something like this. This market started here, this candle started here, closed here. It didn't, like, you see you can see the gap already from the end of the previous candle. Why is this not moving to this point? It's a fair value gap. It's a high probability area that price will come into and react off. There are specific ways you can trade that, but so these are like different things price could be seeking. Liquidity is divided into two. We have the internal range and the external range liquidity. So I'll be referring to them as IRL and ERL. So internal range liquidities are things like fair value gaps. So this is a range, all right? Let me do this, get this here. Okay, this was a low, this is a high. Price formed this low, okay, and then broke this high here. Like, it came down, let me move this upward a bit so it makes more sense. Price came up, created this low, broke this high, all right, broke this high, and then came down, okay, and then went up. Now you're still in range, because especially when the market does something like this. Oh, it's a different one. Okay, so the market does something like this, you're still good. Like, this is a low, this is a high. Price has not violated this low yet, but they create false lows for you to think, you know, it's supposed to hold, right? So even when they do this, it doesn't mean price has, you know, violated the low, right? This low is still protected because they pushed price upward. So they have a vested interest to make sure price does not take out this low. If not, them too, they'll be at loss. Okay, they just want liquidity. So when price does this, when price creates a false low without taking out a previous demand or supply, there's a huge liquidity pool that is being formed here. So it's just like after years and years and years of depositing what's it called, depositing fossils, more like depositing remains from like bones, people, animals, plants, it's now forming this pool that over years is going to become crude oil or fossil fuel. Okay, so once that forms, they have to come down. Once they notice that, they have to come down for it. So they cause false lows like this, you know, and then because so many people are buying from here, somebody bought from here, maybe he put his stop loss here. Some of them might even put stop loss here because they might, you know, base their stop loss off where they want it to be and not where it's supposed to be. Or at the same time, there will be substructures here that they will use as their other lows. Okay, because of that, they put their stop loss there. Another person is going to take another sell here, and he does it the right way. Puts his stop loss below the previous low. Right, that's what you're supposed to do. Okay, but then all of these stop losses is what we call liquidity pool, because if these are buy positions, these people want to take a big buy with huge amount of cash. They need to make sure that there's a lot of sales in the market to absorb their, you know, for them to buy from. All right, so that's what they want. That's what they want. It's actually strategically, you know, it's a game. Forex is a game. We're all just monkeys, you know, pressing a button and hoping we get reward from it. So that's what they want. So they make sure when all of this happens, what they do is they engineer all these lows. You know, it's also called engineered liquidity. All right, but the word is actually inducement. So they induce you into taking buys and put your stop losses here. And then when they now push price from this point, with the funds they have, they can push price all the way. It takes all of you out, right? They'll take their profit from the sales, rather take their profit, and because they've now taken out all these orders, they now have enough sales to buy from to push price upward. Okay, so you always have to watch out whenever you're seeing double top. So it always shows up in the market like this. It always shows up in the market like this, the so-called double tops and double bottoms. So the market is doing this, this, and then you see a particular zone that price keeps respecting, and you know the market is still bullish. There's a high chance that they're going to want to take out all those lows, you know. So this is where the market is, and this is what you're expecting price to do, to bounce off it and go up, right? Because when you trade this, when this person took his trade here, he put his stop loss here, targeted this high. The second man came, price came in, he was like, oh good, very tight order, I don't have to stretch my stop loss, I'll just put it below the previous low, I'm going to have a sniper entry. He does this. The third person comes, sees the second position, like, really nice, these people don't know what they're doing, I mean, I'm gonna make a killing. So because the stop loss is even small, he now, you know, increases his position size. Now the third person comes and price is close, so he does the same thing. All right, increases his position. Mind you, all of these people who have taken trades before, they can keep opening more orders, right? This generates a huge pool of liquidity. This is what these guys want. This is what they need. This is why they made sure whenever price comes in, they make sure price does not come to take this, tap into this demand. They intentionally kept buying from here. Like there's a whole lot to learn in the forex markets. Okay, they kept buying from here. I'm going to like introduce some of these concepts over time. They kept buying with, you know, opening enough positions to keep price from coming down to this point. So when it's now time for them to, you know, eventually, you know, go in for the kill, they now close all those buy positions. And I told you, whenever you close a buy position, it becomes a sell. So that adds to the selling pressure that now pushes price downward into this point. So they'll do that, close all those positions, it becomes extra sell, and then they just need to just put in a little more sells, and then it just pushes down, takes all of you out. If this man is lucky, so the only person that will even survive this might be the person that puts his stop loss below this previous low, because this low is protected by them still, because they have invested interest. They pushed price up, so they have invested interest to make sure their orders are not, you know, eradicated. All right, so this might be the only person that will survive this. Okay, and every other person is going to burn all your positions, all your stop losses now generate a huge liquidity pool for them to, you know, now do this and then push all the way to it. So you see this so many times when price hits your stop loss and then starts going in the direction you wanted it to go. Your analysis was right, but your execution was poor. Okay, so you see it a lot of times. Whenever you see double bottoms or a strong support or a strong resistance, just watch out. Always watch out. So I'm going to show you what that looks like in the market. Okay. You see it here. Very good example. Price did this low, oops, low, created this high, right? But this high didn't break this high, came back down and swung all the way to the stop. So I'm going to this is going to be our original high. Price came down, created this high, it didn't break this previous high. Price kept doing this, it created this low, failed to break this high, created another low, failed to break this high. Now what did price do? It could as well just like go up from here, but no, they knew a lot of people were taking buys from here. People took buys from here. Stop loss here, targeting, let's say they were targeting this, the same, you know, demand. Let me clear my chart real quick so it's not so crowded. Okay, so they knew someone, there was definitely someone in the market that did this, targeting these points. Stop loss below this low, then price did this and another person came and said, "Ooh, nice, I'm gonna do this and I'm going to put my stop loss below." You can already see what's going to happen, right? And then they induced this first person, like they took him out here, and everybody will be like, "Oh yeah, it has worked, like this is the thing." Because I mean, it's bound, maybe this person might even be laughing, like it's bound to happen. Although this person is still safe because you see stop loss is below the previous low, so he was still going to be in the trade, and then the price keeps going up and then he thinks he's actually going to win. And what we do most times is, that's why trading is more psychological than it is technical. When I start adding more positions, maybe as the price did this and came down here, you add another position because in your head you're seeing like a mini demand here, so you enter another position because you think you're going to win. And this is when you now put your stop loss below the previous low. Now we have all of these things generating. Mind you, there's so many people will be entering here and they'll be putting really tight stop losses, so in the end you might have a lot of stop losses here that's just going to be so dense, thus providing enough liquidity for these people to tap into and then move. Okay, so generally that's what we'll now see. Price now comes down, takes all of these things out. It never comes below this low because it's a protected low. They have vested, they pushed price here, so they still have money here, right? They would not want it to come down. Okay, so let's say they even had an order here, the stop loss here. They would not want price to touch that. Okay, so price will come as low as this before eventually pushing. Most times after liquidity has been tapped in, price shoots. It just shoots. The same thing happened here in this BTC trade. I'm going to go down to the smaller time frames and show you. Okay, so whenever you're seeing this, just know, especially when you now, let me analyze this point and show you why price would come down there. Let me mark it with a red. Okay, show you why price will come down there. Let me go to the M5 first. Okay, no, I think I should have gone to M15. I think M5 is too low. Gosh. So if you look at this chart, let me go to M15. It's too choppy. If you look at this chart, you see this momentum candle, this one. Let me zoom in. See this one here. This was a momentum candle. You can say this is also a momentum candle, but it had some selling pressure at the top, so I would not really consider it a momentum. I would actually consider this one because there's very little wick. Okay, so let me zoom in. See the candle. I'll consider this to be my momentum candle. My supply is, my demand rather, is the candle before it. I'm just gonna extend this to the right because I don't have the time to be scrolling and scrolling and scrolling. Okay, and then I'm going to mark the lowest point, which is the protected low with this blue line. So let's move to the future. Oops. You see what price did? Price tapped into the supply, into the demand, never coming close to the you know. So even when you're even seeing this, and it's crazy, like everything you see in the market is true. What you're seeing is correct. What the next man is saying is correct. The person that is buying and the person is selling, they're both correct. So while someone is seeing a break of structure here, someone sees this as a break of structure. Okay, so he's positioning himself to take a sell to that liquidity zone. Okay, because he says this is a broken structure. So the market has told you that I'm actually coming down, and it's there. But just because you're fixed on your buy positions, and that's a bias we have, what's the name of that? It's confirmation bias. So we always like find reasons to believe, to support a flawed idea we have. We always want, you know, even if it's crystal clear that this is wrong, this is going to turn out bad, but because we already invested in that, you know, other decision, we want to look for ways to support what we already invested in. Now somebody is seeing this break of structure, another person is saying no, it's liquidity, they tapped into this supply, which is actually very true here. There's a demand here. Someone is saying, and these people do these things intentionally, because why did they tap into this demand so carefully and then bounce off? Like I said, price is always going to move between supply and demand. So price came, bounced into it, tapped into it neatly. Someone would easily have even taken another trade here. It's a bloody business. Not as bloody anyways, but I mean, there's so much blood in the water already. See how red all of these places. So this happens. Okay, so when this happens, more liquidity pool is being generated. Like it's pulling, the liquidity is like it's pulling. Okay, and then it comes down and takes you out, and then it goes up. Okay, now these people can easily execute that trade here because there's so many people willing to sell to them who want to buy. Now I even use the M15. Let me even go down to the M5. This is even more precise. This is even more precise. So when you look at the M5, oh, this is M5. Was it M15? I was saying this stuff on. So in this case, I'm going to just use this fair value gap. Let me zoom out. So you see what I'm doing. So you see this candle, the momentum candle. Right, so I'm marking the boundaries between the candle before the momentum candle and the level this other candle came into. So you're seeing this whole gap in between. Price tapped into it. All right, let's just go and see. Why did I even? Okay, price tapped into it and moved. Okay, that's another reason. So this is like two reasons why price will come down there. You have an M15 demand, and at the same time, so you also have a fair value gap. At the same time, this is a supply zone. The candle before this momentum candle, which is this blue candle, is a supply zone. Three reasons now why price would come down to that point, and that makes sense. So price just taps into it neatly and then shot up all the way, you know. And it's crazy because if you had stayed in this market from here waiting for when price will come down, you would have spent all of this time. So by this point you're already tired and you're already weary and your mind is seeing what it wants to see because you want to leave. Maybe you've not even slept, you need to go and sleep, so you're just like, and that's when it happens and it takes you out and you go back to bed angry. You might not even go back to bed. You might even want, that's when you want to revenge trade. You want to like make all the money you've lost, and you now make much more mistakes. Okay. So it's a psychological game. It's a psychological game, and I've actually had my fair share of it, of these losses. Okay, and then this takes what? Let me calculate. Let me see how many days this takes. I should have even used the hourly time frame. Okay, so from this point to this point was 2 days and 12 hours. But the moment price tapped into liquidity, it took how many days to get to take profits? It took 2 days. Actually, it took less time than it would have taken to get to take profits. It even took like a day to come close. All right, which that would have. So you see, you spend. That's why they say you spend more time waiting in the forex market. But if you know what you're doing, you can actually take trades in between while you're waiting. All right. So this is inducement liquidity, and what it just means is they're going to induce people into taking a trade and pulling up the liquidity for them to tap into, to taking the, they take the move they actually want to take. All right. Now this is external range. Now I'm saying it's external range because it's within the range, like the liquidity is within this range. Okay. Now external range liquidity manifests as internal range liquidity equals FVGs, fair value gaps, supply and demand. This is for external range liquidity, fair value gaps, supply and demand. Other blocks, which is still supply and demand, because people often mistake these things. They say supply and demand is the same as other blocks, but it's actually, one of them is the chicken, one of them is the egg. So they're always like they always have that yin and yang, dynamics. But actually, supply, let me show you what this is. So this is an order block. An order block is a point where is a level or a zone from which institutions take a big push, a big move, right? So this is a big institutional money, like they put in serious money, so it pushed up, right? And this made a demand zone. All right, now in the future, price is going to come down to it. Okay, and when price comes down to it, price is going to react off it. Okay, so now here's the question. At this point, is this supply, is this demand, or is it an order block? People say it's an order block. It's actually not an order block until price comes down to it. So initially, at this point, it's just demand. It's just a demand zone. When price now comes to it, the institutions now use that point as an order block, because like there are blocks of orders that are stacked here. Like it has to be stacked here for them to like move and do all the things they want to do. And this is a very good example of, or a very good instance where liquidity is going to come in. Liquidity is basically market manipulation. So they might come all the way to the, knowing that you're expecting this place to hold, they might come down like this, never touching it. All right, break structure, and then people start buying from here and start buying, and then in one sweep, it might even happen on a very volatile day, tap into it and then boom to TP. So they could do that. So that's for internal range. All right, then the next one we have is external range, and external range liquidity equals wicks. This is when the liquidity exists outside the range, as the name implies. External range. Let me show you what external range liquidity looks like. And what they do is basically take out the wicks, okay, before they all come together in a very perfect synchrony, very perfect dance. I'll show you where that happened. So they tell you wicks don't lie, wicks never lie. So it happened here, and they all dance together. Now see this point. Let me clear this. Okay, I'm going to mark this zone so I can come back to it. Oops, fuck. Mark nigga. I'm going to mark the zone, extend, right, close. Okay, so hopefully this is the only red zone we have. Let me reduce the opacity. All right, so let's go down to 5 minutes and see what happened there. Let me explain external range liquidity for you. This is okay. So now, like I said, liquidity is just a point where the market is very very volatile. Okay, a period. Liquidity is basically volatility. Okay, so price has to go there to push. All right, so the market was doing this from here, did this, did this, did this, did this, did this, did this, did this. Now it's expected that the price market is supposed to do this and come down. Okay, at least for a while. Okay, and this is not even a very good example, but see what price did. This was the move that broke the structure. Let me close this, zoom in. Look for the move that broke structure. This happened. BOS. Okay. Now, this was the swing high, the strong high that broke this low. But along the swing, there's a substructure. So you're seeing this high, do this, and do this, and do this. So the move that actually broke the structure didn't start from here, it started here. Alright? So you mark out that zone and expect price to come back to it, to take it out. Like, okay. And you see what happened there. Boom. See how precise and accurate it is. Okay, so instead of doing all of these things where people are doing lower highs, lower lows, lower highs, lower lows, you can be taking these trades, right? But the moment market shifts, like here, shifts, breaks the structure, you already know you're in trouble. But generally, the same thing happened here. Same thing happened here. You see, the market, the market did this. Low, high, low, broke this high, right? But it didn't do that straight away. What it did was it came up to this point, came low to this point, came up to this point, came low to this point, and went up. So now what's the last? So along this swing there are substructures, and the last, before this, the low before this low was this. I'm even seeing one other one here, but that one did not hold. Did it? It didn't. It's going to hold in the future. You see how the market is very fractal. What happens in the small time frame happens. Everything from the small time frame eventually builds up to the big time frame. It's just like everything just crescendos into this big, standing waves. If that makes sense. So you see it here. Price did this. Weeks don't lie. Had this week, and then from this point, you can easily sell from this point or take your trades. So all these trades you're taking from here, you're holding them down to take profit here, because price is bound to come here. Alright, but price did that. The moment price came and tapped, took out that external range liquidity here, price headed straight for this other external range liquidity. Okay, so what? Let me see the consequence of this. See what happened. Sells. There were sells here. There was a sell here, which was the best position ever. Another one here was position. Stop loss above this. This person would have even survived. Let's say it's smart enough to push. Price is stop loss slightly upward. Another position here. Stop loss above what? Previous high. All this could be one person. A very greedy person will keep adding positions, especially when he does not know what to do. Keeps adding. Now these are the kind of trades that you take, but then you close when you break even. The moment you're in profit to an extent, you just close those trades to offset the risk you're taking on the initial trades. Okay, so let's say the person does not even know this is where the market is going to end. Most times people will do these mistakes. They actually don't understand the market, so they push it further. Because price has broken the structure, they expect that price is going to keep going down and eventually break the structure. So you now have all these stop losses waiting, right? Except this one who was lucky, and price comes up and takes out all of this. So he now has initially they were sells. So when you hit stop loss, they become buys, right? So they are going to be buying from you and you'll be selling to them. And if they sell, this composite man, which is the market mover, the collective market mover, he wants to take a bigger sell. So he needs all of you to buy from him. So he's going to be buying at a very discounted price, very cheap price, while you guys will be selling to him at a very high price. This is a high. He wants to sell at the highest point. You don't want to buy at the highest point. You don't want to buy here. You want to buy when it's low, so when price goes up, you make money. Like there's a way you would just phase out of this forex charts now and just think about these things objectively. You make money when you buy things cheaper and sell when they are higher. Okay, the only way someone who is selling makes profit is when he sells at the highest price. That's when he makes profit, because the margin between the price he's selling and the price he bought is now lower, it's now like wider, so he now makes more money. So this person wants you to turn all these your sales into buys at a much higher price. So you're buying from him at a higher price, and you don't have a choice. You already handed your money over to the market, and it just comes and takes you out. Okay, so this is, liquidity. This is what you're playing against. You're not. The market is not there to just hand you money. It's only handing money to the people who know what they're doing. All right, and this could be any of us. Sometimes we all get it, mixed up, and sometimes we all get in the rut. But it's just helpful to know what's happening, so you don't think you don't know what you're doing. You actually know what you're doing. Wow, this thing has been done. You actually know what you're doing, but let's just say you're not prepared, or let's just say you didn't see it coming, right? So I'm going to stop this recording here, and the next video I'm going to talk about, the different ways you can take advantage of liquidity and make money. All right, so I'll see you guys next. Bye bye. All right, guys, so this is going to be the end of the course, just because I want you guys to have enough time to assimilate what I've been teaching, and then wait for the live stream. Okay, so this is going to be the end, because I've basically touched everything, but then I'll be going in details, and I'll be showing you, like, we'll be doing this in real time on the live stream. Okay, so just spend the time, watch the stuff, learn, install MetaTrader, just find your way around it. Okay, so we will see again during the live forex course. And a quick reminder, I'll just do well to check the description and get into the WhatsApp channel, because that's where I'll be dropping most of the details as to what time, where, YouTube, Zoom, most likely it's going to be on YouTube. So just subscribe, turn on your notification bell, so when it drops, you'll be notified. I'll see you guys. Stay safe.